Back in 2014, Target lost billions of dollars trying to expand into Canada.
Oh, yeah, billions. It was a total disaster.
Right, but the crazy part is they didn't lose that money because of bad math or, some unpredictable market fluctuation.
No, not at all.
They lost it because their CEO just refused to admit he was wrong. I mean, it was this massive failure of human ego.
Yeah, absolutely.
And what is wild is that we are looking at this case study today, and we're looking at it through the lens of a finance and accounting textbook.
Which is probably the last place you'd expect to find a lesson on human psychology and ego, right?
Exactly. We are doing a deep dive today into a specific excerpt from Chapter 13, which is titled Final Thoughts.
Yeah, and normally you would expect a finance text to be all about, conservatism, risk aversion, just playing it safe and making sure the columns balance perfectly to the penny.
The Department of No.
Right. Exactly. But this chapter actually argues the complete opposite. It says that traditional, risk-averse, accounting-oriented management is the exact thing that destroys companies when the economy hits rough waters.
Which is fascinating.
It is. I mean, the author points out that the 2008 to 2010 financial crisis was supposed to permanently change how businesses operate. It was supposed to be this huge wake-up call for clear corporate thinking.
But they didn't wake up.
No, so many organizations are still relying on outdated assumptions. They just went right back to sleep.
So our mission for this deep dive is to extract these actual mechanisms of how companies adapt to turmoil, these outside-the-box contrarian survival strategies. We want to figure out how they can adapt without just panicking and making the same restructuring errors over and over again.
Okay, let's unpack this. Because before we even get into how companies botch their restructuring, we have to look at the pressure cooker they're operating in right now.
Yeah, the environment is just incredibly volatile. The text paints this picture of a global marketplace defined by absolute turmoil.
Right. The ground is constantly moving under these businesses. The source highlights these massive currency fluctuations, like the surging value of the dollar against the euro.
Which changes everything for exports.
Exactly. And then you're looking at extreme commodity shifts, things like a 50% decline in oil prices essentially overnight, periods of zero inflation, and deep economic instability in places like Asia.
And because the ground is constantly moving like that, the old rules of competition are just dead.
Oh, completely dead.
One of the most brutal realities the author outlines is that product quality is no longer a differentiator.
No, it's not.
It is just table stakes now.
Crazy.
Like, you can't justify a multi-tiered pricing structure by offering a low-quality versus high-quality version of your core product anymore.
Right, because consumer expectation has totally shifted. Differences in product features or, say, performance capabilities, that is totally acceptable. But a difference in performance quality, no. Consumers simply will not tolerate a deficit in reliability.
If it breaks, you're done.
Exactly. They expect it to work perfectly every single time, or you're immediately out of business. And then you have to factor in the constant pressure of Moore's Law on top of that dynamic.
Right, Moore's Law. Knowing that technology capabilities double while prices drop by half every few years, that inherently drives extreme price sensitivity across your entire customer base.
Yeah, it creates massive margin compression. And historically, to survive that compression, companies leaned really heavily on vertical integration.
Right, they want to own everything.
Yes, the entire manufacturing process from top to bottom just to control costs. But the text argues that owning the whole process is out now. Masterful supply chain management is in.
Okay, I love this part. I was thinking about it like this. It's like realizing you don't need to own the cow, the dairy farm, and the delivery truck to sell ice cream, as long as you can get the milk faster and cheaper than the other guy.
That is a perfect analogy because tying up massive amounts of capital in the farm makes you slow. You're vulnerable when the market shifts. What you actually want is agility.
So compressing the supply chain gives you that agility.
Exactly. Compressing that supply chain has these massive ripple effects on the balance sheet. When you shorten the time it takes to get materials from your suppliers to your company and then out to the customer, you hold significantly less inventory.
Makes sense.
And lower inventory immediately improves your accounts receivable, which maximizes your cash flow. And in a volatile market, cash is oxygen.
Cash is oxygen. I like that.
But more importantly, that agility translates into highly responsive service levels. The service level, not just the physical product, is what actually captures market share and drives sales growth now.
Right, because if everyone has a high-quality product and technology is constantly driving prices down, you are faced with a pretty brutal reality about how to win business.
You really are.
The text frames this around 4 existential questions that every organization just have to answer. First, why are we special? Second, why do we deserve to exist?
Those are heavy.
Yeah. And then third, why should customers buy our products? And the last one, the one that really hits hard, why do we deserve to have our customers' money?
It's a gut punch, right? Because it forces a company to justify its extraction of wealth from the market. Why do you deserve this money?
Right.
And the author's solution to answering that question involves a total shift toward consultative selling and strategic partnering. You aren't just pushing units anymore. I mean, anyone can set up a dropshipping operation and move commercial goods today.
Exactly. That's easy.
So you have to offer genuine insight. You have to diagnose your customers' problems and identify their blind spots. That's consultative selling.
And then strategic partnering takes that philosophy and points it outward, right?
Yes. The mindset is that your entire existence as a vendor is to help your customers sell their products to their customers at a higher profit margin.
You become indispensable.
Exactly. You become so enmeshed in their prosperity that they literally can't fire you without hurting your own bottom line. The text actually uses a really great everyday example for this: standalone GPS units for cars.
Oh, I remember those.
Right. Like, why would a consumer buy a physical GPS device today when their smartphone has a free, constantly updated navigation app?
They wouldn't.
Exactly. So the GPS companies that survived that technological shift had to find completely new ways to add value. They pivoted to fleet management or aviation or integrated dashcam data because their core consumer product was essentially commoditized to zero.
Wow.
They had to partner with entirely new industries just to stay alive.
Okay, hold on. I need to play devil's advocate and look at the math on this for a second.
Sure, go for it.
Because we just established that prices are constantly deflating and customers are ruthless about costs. Consultative selling sounds wonderful, but it also sounds really expensive.
It is.
Right. It requires highly trained, expensive sales professionals spending hours and hours diagnosing bespoke problems. So how does a company actually afford to fund that level of customer support while their margins are shrinking?
That is the million-dollar question, and the author makes it a mandate. Investing in high-quality marketplace visibility through your sales force is the single most profitable investment you can make, period.
Okay.
But to fund it, you have to be ruthless about resource allocation. This is where the text leans on strategic tools like the BCG matrix, the Boston Consulting Group matrix.
Ah, right, with the cash cows and the stars.
Exactly. You have to relentlessly milk your cash cows, the steady, reliable parts of your business, to fund your innovative stars. And you have to immediately divest from the dogs, the failing or stagnant areas.
Cut them loose.
Yep. There is absolutely zero room for dead weight on the balance sheet if you want to afford an elite sales team.
And that lack of room for dead weight brings us to kind of the dark side of this equation. Because when companies fail to answer those 4 existential questions, they bleed cash, they hit financial distress, and they panic.
Oh, the panic is real.
Yeah, and sometimes the U.S. government even has to force them to wake up, like with the bailout conditions imposed on General Motors or AIG after the 2008 crash. And in that panic, they initiate restructuring plans that almost always self-destruct.
Yeah, the text outlines 7 deadly mistakes companies make here. And the first 3 are all part of what they call the downsizing delusion.
The downsizing delusion.
Right. The very first instinct of a panicked organization is to slash payroll. But they invariably target the lower-level support staff.
Mistake number 1.
Mistake number 1, because the middle and senior managers are the ones designing the restructuring plan, so naturally they insulate themselves from the cuts.
Which is an incredible operational failure. I mean, think about it. You save a fraction of your budget by firing the support team, and the immediate result is that you have too many chiefs and not enough Indians.
It's exactly.
Suddenly, your 6-figure executives are spending 40% of their week typing, photocopying, and handling basic logistics.
They are doing admin work instead of the high-level consultative selling we just talked about.
Right.
They cut a relatively low-cost line item, but they completely destroy the massive value generation their executives are supposed to be driving. They essentially blindfold their best people to save a few bucks.
It's just wild.
And this ties directly into the next fatal flaw, mistake number 2, which is retreating to organizational comfort. When humans are stressed by market turmoil, they crave the safety of what worked in the past.
It's a slow death by nostalgia.
That's a great way to put it.
They look at a crumbling market and say, well, in 1998, we ran this promotional campaign, and it saved the quarter, so let's just do that again. They see the future as just a linear extension of the past, completely ignoring that the entire landscape has fundamentally shifted.
Yes, but we have to be careful here because the text introduces a nuance for mistake number 3 that can feel a little contradictory on a first read.
Okay, let's hear it.
Mistake number 3 is not recycling past ideas that actually merit current consideration.
Wait a minute. I'm
Yeah.
confused. A minute ago, we were saying nostalgia is a trap, and mistake number 2 is sticking to the past. But now mistake number 3 says we should recycle past ideas. How do you reconcile that?
I love that you caught that. It all comes down to context and timing. Think of it this way. Nostalgia is doing something again simply because it worked before, regardless of current conditions.
Okay.
Recycling an idea is doing something despite it failing before, because the current conditions are finally right for it.
Oh, I see.
The author gives a great example with e-commerce. Imagine a company trying to sell hardware online in 2001.
Yeah, that would be rough.
Right, the infrastructure wasn't there, consumers were terrified of entering credit cards on a website, and the initiative just failed miserably.
So the executives walk away thinking, internet sales don't work in our industry.
Exactly, and because of that early failure, they stubbornly refused to reconsider the strategy in 2015 when the entire world had shifted online. The text points out how Home Depot dominated by recognizing that the timing was finally right to merge online sales with physical store pickup.
Oh, right.
While many car dealerships lagged years behind because they just couldn't shake their old assumptions, you have to evaluate the idea based on the environment you are standing in today, not the one you were standing in a decade ago.
That makes a lot of sense.
Yeah.
And evaluating today's environment accurately requires a pretty sober look at how you're pricing your products.
Absolutely.
Which brings us to mistake number 4. Because if you aren't firing your support staff and you're paying for this elite consultative sales force, there is massive pressure to drive revenue. And when sales dip, the knee-jerk reaction across the board is to just offer a discount, to just slash the price to get cash in the door.
The author strongly warns against that. Mistake number 4 is reducing price rather than adding value, because a discount trains your customer to expect future discounts.
Yeah.
It completely commoditizes your relationship with them.
And it breeds resentment. The text points out that when you suddenly drop your price by 15%, the customer doesn't just think, wow, what a great deal.
No.
They think, if you can afford to sell this to me for 15% less today, have you just been gouging me for the last 3 years?
Exactly.
You erode the trust that you spent years building.
And the alternative is holding your price steady but aggressively adding value. You offer faster delivery guarantees, or you host user conferences to educate their teams. You upgrade their customer service tiers.
Give them more.
Right. Because the source notes that it is incredibly difficult to get a new customer, and it's a challenge to keep an existing one. But getting back a customer you have alienated over a perceived pricing betrayal, that is almost impossible.
Which is such a critical point. And this concept of protecting your energy and your value transitions perfectly into mistake number 5, which is how companies manage their customer base. We've all heard of the 80-20 rule, right? The Pareto principle.
Oh, sure.
Usually it's celebrated. 20% of your customers provide 80% of your revenue. 20% of your products make up 80% of your shipments. It's presented as this blueprint for success.
But the text forces us to look at the dark underbelly of the 80-20 rule, which is far more destructive to a company in turmoil.
Here's where it gets really interesting.
Yeah, because 20% of your employees account for 80% of your absenteeism and HR issues. And crucially, 20% of your customers are responsible for 80% of your overdue accounts receivable and your service complaints.
If you are listening to this and you run a business, you know exactly who these clients are.
Oh, absolutely.
It's like discovering that the squeakiest wheels in your life aren't just annoying. They are actively draining 80% of your bandwidth while contributing almost zero to your actual growth. You end up with an entire organization that is just emotionally exhausted, running around, putting out fires for nightmare clients, but they aren't actually being effective.
Yeah, it is the trap of confusing activity with productivity. You see these overworked teams giving desperate, fanatical attention to every single minor order, thinking that sheer effort will save the quarter.
Right.
But the author lays out a rigid formula here. Achievement equals productivity, which equals effectiveness, which equals profitability. Pure activity, just running on the hamster wheel, is entirely missing from that equation.
Because if you dilute your effort across the least important 80% of your business, the late payers, the low margin complainers, You guarantee that your vital 20%, the clients who actually fund your survival, don't get the premium consultative service they need to grow.
Exactly. Intelligent management is having the sheer discipline to let the bottom 80% slide, or even firing those bad customers entirely so the most important work actually gets done.
But firing a client or shutting down a struggling division, that requires a terrifying amount of honesty.
It really does.
It requires executives to put their egos aside. If you actually audit your company using that negative 80-20 rule, you will inevitably find massive drains on your resources. And that leads to the final two mistakes, 6 and 7, which are probably the most psychologically devastating errors companies make during restructuring.
Holding on to sacred cows and relying on a dominant customer.
Yes. We have to unpack the sacred cow concept because it goes right back to that Target Canada story I mentioned at the very beginning of the deep dive.
Mistake number 6.
Right. A sacred cow is a project, a product line, or an entirely new market that consumes a vastly disproportionate share of corporate resources.
Yeah.
Its performance absolutely does not justify the investment, but it is kept alive anyway out of executive pride, stubbornness, or just a flat-out refusal to admit a mistake.
It is the sunk cost fallacy, fully institutionalized. Target decided to enter the Canadian retail market, and instead of, testing the waters, they committed billions.
They just went all in.
They opened over 100 stores almost simultaneously, bought out an unsuccessful existing retail chain, and forced massive capital outlays before they had any real data on whether Canadian shoppers even wanted their specific retail experience.
And the execution was a disaster. I mean, supply chain issues, empty shelves, massive daily losses.
It was bad.
But the CEO refused to acknowledge the failure. Closing the stores would require standing up in front of the board and admitting a multi-billion-dollar miscalculation.
Yeah.
So his initial decision became a sacred cow.
Yeah.
He forecast 5 more years of continuous losses, just hoping to eventually break even, essentially bleeding the core company to protect his own pride. It's just wild to me.
It is staggering when you look at the sheer numbers. It actually took bringing in a brand new CEO in 2014, someone who had absolutely no emotional attachment to the project, to finally slaughter that cow.
He just came in and cleaned house.
He came in, immediately closed every single Canadian store, took the massive financial write-down, and cleared out the management team that orchestrated it. Compare that to Nordstrom, who entered Canada around the exact same time but started with just 2 stores.
Ah, right.
Minimal capital outlay, testing the market, adjusting to reality.
The text also highlights GE Capital as a fascinating contrast to Target here. During the 2008 crisis, GE's financial institution represented 40% of the entire company's business. It was this massive sacred cow that they had relied on for decades. But leadership recognized the existential threat that kind of exposure created in the new market reality.
Yeah, they projected a decade-long plan to aggressively reduce their financial business to under 10%. They chose to carve up their own identity to return to being a pure industrial company. They survived because they were willing to kill their darling.
Right.
And you have to have that same ruthlessness when dealing with your customer base, which brings us to the final restructuring mistake, relying on a dominant customer.
This one, on the surface, feels completely counterintuitive to me. Like, if you land a massive whale of a client, you pop champagne, right? It feels like a huge win for the sales team.
It is thrilling in the short term, but the author warns it is incredibly dangerous. If a single highly valued customer grows to represent more than 10% of your total business, and you don't have ironclad long-term contracts protecting you, that customer suddenly holds all the leverage.
They essentially own your business without having to buy your equity.
They do. And they become arrogant. They know you can't survive without them, so they start dictating onerous terms. They demand lower prices. They force shortened delivery windows. They stretch out their payment terms. They basically treat your supply chain as an extension of their own.
And if they ever decide to leave, or if they pivot their own strategy, you are just decimated. The text points to Qualcomm, a massive tech giant, taking a severely long time to recover after losing Apple as its largest customer. The concentration of revenue was just too high to easily replace.
The historical example of Sears is even more telling here. In the 1980s, Sears was a retail behemoth, and they were notorious for acting as a dominant customer to their smaller vendors.
They really threw their weight around.
Oh, yeah. Extracting severe price concessions and demanding impossible terms until those vendors were literally pushed into financial distress.
The irony there is just poetic. By bullying their vendors to boost short-term margins, Sears systematically destroyed the health and innovation of their own supply chain.
Yep.
The source notes that Sears went on to become one of the absolute worst financial performers of all retail chains in the 10-year period, ending in 2016. They slowly bled all their market share to competitors like Home Depot and Lowe's, who treated their supply chain as strategic partners rather than, serfs.
Looking at the wreckage of Sears, or the billions burned by Target, it really drives home the core thesis of this textbook excerpt. The numbers on a balance sheet are ultimately just reflections of human behavior. Choosing to bleed cash to protect your pride, or letting a whale of a client bully your staff because you are afraid to diversify, those aren't mathematical miscalculations. They are emotional failures.
That is so true. So, surviving economic turbulence requires abandoning the organizational comfort you are used to. It requires answering the brutal questions about why you genuinely deserve your customers' money. It means holding your price steady while aggressively adding value, having the sheer discipline to ruthlessly apply the 80-20 rule to protect your energy, and being willing to slaughter your sacred cows.
And, if you're listening to this, I want you to consider how these corporate principles apply outside the boardroom.
Oh, I like where this is going.
We have talked about the 80-20 rule, sunk cost fallacies, and dominant customers in the context of multi-billion-dollar supply chains. But what happens if you audit your personal life, your career trajectory, or your daily habits with these exact same metrics?
Wow, that is a heavy question.
Think about it. What is the sacred cow in your own life right now? Is there a project, a habit, or a relationship that is draining 80% of your resources while providing zero return? Are you holding on to it just out of pride or because it feels comfortable? And if you can identify it, are you brave enough to cut it loose?
That is definitely something to chew on long after this deep dive ends. We love pulling apart sources that flip our basic assumptions upside down, and exploring the psychology behind the accounting definitely delivered today. Thank you so much for joining us as we unpacked all of this. Take care, and we will catch you on the next one.